Welcome to Trillions. I'm Joel Weber.
And I'm Eric Balchunas.
So we spent last episode talking about why the U.S. is so great.
Yeah.
Is there a contrarian take that we should visit today?
Yeah, so a couple things. First of all, yes, I still think the U.S. has some elements that are special, but this year so far, Joel, Europe, which a lot of times gets dumped on, narratively, it's been in the doghouse for years. It's basically tripling the S&P 500 this year. It's up 9-10%. S&P's up 2.4%. Will it last, or is it another head fake? I think it's a good time to give Europe at least a strong case. We were a little negative last time, and I thought, it'd be a good time to look at the other side of the story, and maybe there is a reason to allocate there. We have, on our team, in the broader strategy team, there has been some research and data that indicates it might actually be for real this time. And I thought we should share all that, get it out on the table, and then the listener can decide. We'll let them be the jury.
Okay, so joining us, we're going to have your boss, Gina Martin Adams, who's the chief equity strategist at Bloomberg Intelligence, as well as Todd Sohn, who's the senior ETF and technical strategist at Strategas Securities. This time on Trillions, the case for Europe. Todd, Gina, welcome to Trillions.
Thank you. Thank you for having us.
Great to be here with you guys.
Quick note here. Todd is such a trooper that he is doing this from LaGuardia Airport in the pet relief station.
That's a first.
That is a first. So if you hear any little background noise, that's why. And if a dog pees on his leg, we promise we'll let him re-record that part. Okay. So just FYI, thank you, Todd, for being so dedicated.
Eric, I want to start with just what is the data when you guys are assessing something like this? What are you looking at beyond just indexes?
Right. So one of the things that has been apparent for a while is the valuations, right? In the U.S., the average price to earnings ratio is very high. In Europe, it's lower. That gap is pretty much, I think, at historical records, right? So that's the data we would look at. Now, we don't maybe go more than a couple feet deep in the ETF world, but I work with people who go deep into the numbers. So Gina has put out some reports recently that talk about the weakness in the U.S. and ipso facto a little strength in Europe. And then Todd put out a note that I read about, 3 months ago, where he said, I think he called the case for Europe, but his thesis was it can't get worse, which I thought, what an investment thesis is. Hey, come invest here. It can't get much worse. Anyway, that's sort of the state of Europe. So I think we start with Gina with just, the U.S. weakness maybe and how that relates to Europe maybe having some good signs.
Yeah, and it's very much the same case, just in the polar opposite that you just made, where Europe by November of last year was trading at an all-time historic discount relative to the rest of the world. The U.S. was trading at its peak relative to the rest of the world valuation premium. So the U.S. case, the anti-U.S. case is really the opposite of the pro-Europe case when it comes to valuations. At the same time, you have to work through the mental gymnastics of what that really means. And what that really means is expectations for the U.S. going into 2025 were extremely high, whereas expectations for Europe are extremely low. And momentum shifts in global stocks oftentimes occur because of expectation extremes. There's almost no chance that the expectations embedded in U.S. stock prices can be met by U.S. companies, at least in the short term. And you have that adjustment process that emerges. And we've seen that play out real time through earnings season, and in particular with tech, where suddenly we have competitors in the tech space that no one thought would exist 3 months ago. That creates a very different environment for tech and for the U.S., whereas for Europe, there was no expectation for growth. And suddenly earnings estimates stopped falling. So it wasn't a fantastic evolution of great news for Europe, but expectations were so low they couldn't get much worse. And then we have decent earnings come through. You've got the central bank still easing. You've got some relief in terms of political pressure that has emerged over the weekend with Germany. And that's been enough to get a little bit of momentum moving in the favor of Europe.
Can I say this differently and see how you react to it? Is the U.S. the ultimate growth story and Europe is the ultimate value story?
Yes, I think that's a lot of what we're seeing is also the U.S. is the ultimate tech story, and Europe is in some cases the ultimate financial story. So it's a growth value, expectations dichotomy, and sector performance dichotomy that creates an opportunity for Europe and probably puts the U.S. behind rest of the world, at least in the short run.
Todd, let's go ahead and bring you in. What did you see as you were working on your thesis?
So I agree with Gina about low expectations, and to me, it's all about sentiment as well. And one of the funny ways I think I can sum up European ETFs listed in the U.S. is there's 50 ETFs, both combined of the region as well as single country, and they have about 57 billion in assets. And keep in mind, these have been around for about 25 years or so. Take that in comparison relative to the iShares Bitcoin ETF, which has only been around for about 13 months, and that has the same amount of assets. So along with the lines, if it can't get any worse, we're talking about a newer asset class that has the same amount of assets as what is a cornerstone of investor portfolios for international. And I think along with just assets under management, you look at product launches. Issuers have given up on the space. There's only been 2 European ETFs launched over the last 6 years, and they're both very thematic, focused on luxury goods and aerospace and defense. So I like that there's this apathy from issuers. They're not really focusing on the region. I think that's really interesting from an expectations and sentiment standpoint.
So Europe is having this nice pop, I'll call it, right? Up 10%, that's a lot for Europe. But the flows are not there. Normally, you have a little run, the flows will follow, at least some models will go in, but there's been about just shy of $1 billion into European ETFs from U.S. investors this year. Now that compares to about $80 billion that have just pumped into U.S. equities as usual. My thesis is that it would take 6 to 9 months to kind of overcome the feeling that we've seen this movie before, or I call it a short film, where it's 2 months of Europe, and then all of a sudden the queues, like a runaway bus, just like runs over Europe once again. And that's happened like 10 times. And so I understand the Pavlovian response to like not do anything and just wait for the queues to come back. Do you think this has legs, basically? And do you think that's when investors might actually turn around?
I love comparing this to short films, which is like its own category in the Oscars. But like, did you watch it? Not really. You watched the best picture, right?
Yes. But I think we need to think about how we measure the legs, right? There's a very distinct possibility that Europe gathers legs without the ETF universe recognizing it, because the biggest investor in Europe is the European investor. And that's where you saw the biggest flight from Europe occur, is Europe for Europe was no longer a thing by 2024. So I think first you probably get direct investments from Europe in Europe. Some of that is a real nationalistic sentiment that could emerge as a result of the political environment. Some of it is a currency play. Some of it is a financial play as a result of the ECB. But we may not actually see U.S. investors contribute to the European story in the form of flows in the ETF landscape, and that we could still see Europe outperform. I would agree. To get the U.S. investor interested in Europe, it is a much, much bigger hurdle. The U.S. investor is very isolated in their strategy. They think that all they need to own is the U.S. The U.S. is the best way to invest in the globe, is a lot of the rhetoric that you hear from the U.S. investor base. That theory will have to get dismantled through several months, if not several quarters, maybe even several years of evidence before the U.S. investor capitulates and says, I'm going to fly into Europe, I'm going to buy a bunch of Europe as an opportunity. It just is very unlikely. It could emerge, this is something that's very unique to this situation, in a world where we have deglobalization as a centralized theme. U.S. companies will potentially have less access to the rest of the world, will become much more isolated as inherent entities. And if that's the case, then suddenly this thesis that you can only invest in the U.S., you only need to invest in the U.S. in order to access global markets, really starts to go away. But that's a really long-term, long-tail secular possibility. It's not likely to emerge in the next month or two.
And just to give some data behind that, Athanasios on my team ran some numbers, and the last couple of years, a lot of people overseas have invested in the U.S. That's helped the markets. Mm-hmm. Europe, though, the percentage in the U.S. has plummeted this year. So they are the ones driving this rally. But elsewhere in the world, it's still gone up. People like Asia still buying the U.S., U.S. still buying the U.S. So it is interesting. I have this narrative thing that I think, and narratives matter. I think they can change. Price can change narrative. So if it goes up enough, the narrative could be broken. But I think most people sit there and think, well, look, yeah, maybe there's a mean reversion trade here. But long term, there's more growth in the U.S. People here work crazy hours. I wrote a note about Jack Bogle, who said you don't need international. And he got more savage as he got older. And here's what one of the lines he said was, everyone says I'm wrong. I said for a lot of reasons you don't need international. And he says something here. The third largest country in IFA is France, the soul of hard work. I can't see that I'd make more money in Britain or Japan, yada, yada, or France, where they couldn't pass a law saying you had to work 35 hours a week. And I think generally Americans are like, in Europe, everyone's at the cafe at 3 o'clock. Yeah, the companies actually run, but it's just to get enough done to not go to hell. And I think in the U.S., everyone is in such fierce competition. You get all these flowers blossom in the forms of new companies and growth and opportunity. How true is that narrative, and how hard would that be to erase?
I think it's pretty true, frankly, though I go back to my thesis that a lot of that narrative also is about globalization. In the era of globalization, where the U.S. was becoming this global hegemon, where the U.S. was driving activity, where U.S. corporates were constantly seeking international locations for the destination of their products, where they had tremendous global dominance, of course the U.S. companies were more productive. At the same time, you're absolutely right. The structural landscape, the policy landscape in Europe became less and less productive, more and more government interventionist. I think you're at a moment now where Europe is starting to recognize that. In particular, in Germany, we saw it very, very profoundly over the course of the last year. In Germany, the Germans themselves are recognizing that they're taking a backseat economically and financially to the rest of the world, and there's a lot of frustration there. So I think there's a potential rallying moment for Europe to think about privatization, think about ways to enhance productivity, think, frankly, about how to form global relationships outside of their relationship with the U.S. So you could make a case that as Germany becomes tighter with China, for example, as Germany seeks other markets to enhance its productivity and global presence, you could see some pretty big sea changes in Europe. The other thing that I would say that's so fascinating to me with respect to Europe right now is the countries in Europe that went through a reckoning moment in the European debt crisis. Now, I know that this is a long time ago. Not a lot of us remember 2011, but it was a big moment in time for Europe, but only for the debt-laden, what we called at the time pigs economies, Portugal, Ireland, Italy, Greece, and Spain. Those economies have transitioned remarkably over the course of the last decade and change. Those are the areas of Europe that are starting to outperform most profoundly. The best performing markets in Europe this year are Spain, Italy, Switzerland to a lesser degree. Germany certainly is participating. But where did Spain and Italy come from? That comes from a legacy of change, right? And in the European debt crisis, they had a moment of reckoning. They had to right-size spending. They had to think about structural changes. Many of those appear to have been enacted, and the economic optimism in those peripheral economies is significantly greater than some of the other legacy economies, like you used the example of France or even Germany. So I think that, Europe is a conglomeration of countries, and that's something that we need to keep in mind as well. Europe as one big entity, maybe not as investable as some of these other smaller country markets that have been doing very well over the course of the last year or so.
But to Todd's point earlier, there's a dearth of products.
Yes.
Todd, is there a big opportunity here to actually bring some innovation in ETFs to the space?
So I totally agree with what Gina's saying about the countries are changing, right? How they function. And I think this is where there's opportunity for active managers, right? It's nearly impossible based on data to outperform US large cap growth. But because Europe has struggled in terms of performance for so long, I wonder if you have an opportunity for active Europe, not just active developed markets, because those already exist out there. But there are no active, straightforward European products. And I think those managers can find, the winners of this change that's going on there. I mean, I do think it's really interesting. The constituency of European ETFs are changing. They were typically very financials heavy, and that's still true. But consumer staples influence in the European ETFs has really dropped over the last few years. And now you're seeing more industrials take control, and as well as technology. I mean, SAP on a given day is the largest weight in Europe. I'm not sure how many people know that if you put 50 people in a room. They might guess it's a financial or a healthcare type of company, but it's SAP, and then there's ASML. So I like that there's this change going on in the way we invest in Europe, and I do believe it also speaks to where active should focus in terms of ETF issuers.
Todd, one more question for you is, what I've found as an ETF analyst over the years is when it comes to emerging market countries and even developed market countries, a lot of the money that would go into, say, VGK, which is the larger Europe, is retail. And that's the money that's not biting right now. However, if you take UK or France or Germany, there is about $1 billion in each of these single country ETFs, but they tend to be used by traders who are usually betting ahead of an election. And so a lot of times, like the Brazil ETF comes to mind, if there's some kind of a big event coming up that's geopolitical, a lot of times you'll see flows rush in ahead of that, and they'll it's almost like a geopolitical sports book. They're like, I really think UK is going to bounce with this election or this situation. Do you think that is what we need to see first, is a couple traders get excited with the single country ETFs, and then retail will follow with the sort of bigger, broader ones later?
I think so. That makes sense. And I'm not even sure about retail, but I'm more so looking at the model providers, right? So you can look at JP Morgan, you can look at State Street and see what their allocations are to Europe as well. And I don't see much going on there right now. So I think this is the great part about ETFs is that, as mentioned, you can place a bet on an event outcome, election, whatever it might be. But I don't know if Europe, if retail will follow along or not. It's not sexy enough. It's not leverage. It's not semiconductors.
What about,
you know what I mean?
What about
crypto.
2x pigs? Does that start to get spicy? And in Europe, you can go 3x.
Put 2x on anything, and you'll get a couple bites.
I boil it down to, okay, will retail come back? I don't know. And then when do the models start coming back to overweight Europe? And I'm just not sure we're anywhere near there yet. It'll take far more outperformance for that to continue.
And I have a question for you, Gina. Does Europe even have tech? I mean, you think, I looked at the best performers in Europe. The financials have driven it. They're up 14%. But I'm looking at the performers. I don't really see any tech ETF. Is there even a Europe tech ETF? I'm not sure if one exists. Todd would know real quick.
Not in the U.S.
It's almost like an oxymoron. Is it?
And
there's Europe
tech
luxury goods.
Jumbo Shrimp, military intelligence?
Yeah, there was one play in Europe with a semiconductor wave, and that was ASML. You have SAS out of Germany, but this is a very small component of the European broader market. And that's the biggest reason, I would suggest, why Europe underperformed the last 2 years, is there just isn't a lot of tech, and tech was the area of growth opportunity. It was the area that led global indices. Not just the U.S., but global markets with the most tech exposure outperformed, a.k.a. Taiwan, was a huge outperformer. So that legacy of limited tech is a big part of the story for why Europe was not performing. Now it's helping because tech dropped. It was the only sector in the U.S. that dropped in January. It's not been performing well so far this year, as investors are rotating into other opportunities, and tech has proven to be a bit of a laggard.
This really does feel like, to bring it back to that growth versus value thing, it's like growth will run away with everything, and then every once in a while, every decade, value will show up, and it'll be the big
Well,
number.
if you look at the long term, when did Europe actually outperform for an enduring period of time? It was in the 2001 to 2007 period, when tech took a backseat to everything. Tech was kind of there, but not outperforming everything, not leading markets. We had a commodities boom. We had a financial sector boom through a lending cycle. That's the type of environment in which Europe will outperform, inevitably because of constituent bias and concentration.
One question, if you're somebody who has a large chunk of your equity allocation in U.S. ETFs, would you would it make more sense just rotate to international and have some Asia in there, or maybe just do Asia? How does Europe compare to other regions relative to the U.S. in terms of this, like possibly having a moment coming up?
Yeah, it's very interesting because China has actually performed very, very well so far this year, but India has been officially in a bear market. So Asia is in the eye of the beholder. What do you mean by Asia, I have to say? Because if you think of Asia as China, then it does appear that opportunities are emerging in China, particularly now that we have tech plays emerging as a potential competitor to the U.S. But Asia is a very mixed bag because India is in a bear market now. And we have to acknowledge that India had some unique structural issues as well that elevated prices there, even as much as they were elevated in the U.S. And now India is taking a back seat. So Asia is a bit of a mixed bag. When you look at Latin America, you also have a really mixed view between Brazil and Mexico. Emerging markets in the Middle East and Africa stand out for us as an opportunity, but the investability of that region is hugely questionable. How do you even get access to that region? How do you put money to work in that region? But that does appear to be a region of the world where emerging opportunities are huge. Yeah, definitely helps. Japan and Australia are areas of the world that we haven't talked about. So if you want to talk developed market Asia, Japan and Australia are two totally different markets. Japan is also in a bit of a slump after leading along with the tech wave until the middle of last year. And Australia is a very commodity-sensitive sector. So it depends on what your thesis is. These are all very, very different markets. But right now, yeah, Europe kind of stands out relative to the rest, mostly because of that valuation discount.
And can we talk about the currency real quick? Because Todd is old enough to remember, like I am, that about 10 years ago, these currency hedge ETFs were like rock stars. So HEDJ was the big one. Hedged Europe, that one's up 12% this year, so 2% better than regular Europe. What about that? Could a strong dollar actually maybe bring people in back to that currency hedge trade?
Yeah. Yes. Currencies are a big theme for us this year. We've been focusing a little bit more on the yen than anything else. The yen, is typically a very risk-off signal. The yen performing very well would suggest that maybe some of our optimistic assumptions regarding global equity performance should be questioned. But with respect to Europe, there are quite a few people who suggest that it was really the dollar rip that ultimately created the downside for Europe in the latter part of last year, because as the dollar was ripping, the euro was the predominant downside risk. That plays its way through earnings in the short run in a very, very negative way. So we saw massive negative earnings revision momentums when the dollar was at its biggest rip or its biggest gaining at the point in which it was gaining the most. Now we're seeing a little bit of normalization there, and that may be helping Europe. But generally, if the euro gets cheaper, that's great for European exporters. And a lot of these developed market European groups are very sensitive to European exports. So if you get a combination of China's growth improving and the euro getting cheaper, that's usually a pretty good sign that we're going to get some earnings momentum emerging in Europe. And that may be starting to price in.
For the less sophisticated folks out there who listen, I'm always a fan of the 50-50 allocation, 50 hedged, 50 unhedged. Just because it's so hard to get a market right and then get the FX right of it, that I wonder if that's just the watered down version of trying to play Europe or international. And there's ETFs for that. So I like the 50-50 aspect.
Okay, so just speaking of ETFs for that, I thought what you said earlier about this being a great opportunity for active investors, potentially. If you could put together that 3X pigs or what have you, what would you want this to look like for Europe? If you could go into Europe and have exactly what you want, what would it look like?
Well, I like to defend the industrial names. I think you have to have some of those European tech because they've been a beneficiary of this.
Yeah.
And
you mean the one stock?
There's two. Is
that what you mean?
Two stocks.
I'm sorry. Sorry, two.
SAP, ASML. And then the financials, this is the first time I can remember that they're actually leading and not causing a problem. I think this is amazing that we have European financials are just chugging higher. And I think if you're really going to have an issue, whether it's within Europe or within the global economy, you'll start to see those names and their credit backdrop really deteriorate. I'm sure Gina will be on top of that as well. The European financials, EUFN, I think it's about to hit a new all-time high, Eric. That's a long time coming, historic.
By the way, there is a 3x Europe ETF.
There you go.
Guess how much in assets it has, Todd?
Oh, God, I don't even know what the ticker is, to be honest with you.
It's
I forgot about it.
EURL, 22 million, which is really small.
Oh.
That means no one cares. There's no juice.
No,
but
this is part of the argument.
But
no
if Europe pops, like this one's up 30% this year because it's triple Europe. Need more though, but you got some of these single stock ETFs go up 30% in a day. So this is like child's play at this point.
All right. Well, we have the thing that we can watch now. Todd, Gina, thanks so much for joining us on Trillions.
Thank you for having us.
Thank you very much.
Thanks for listening to Trillions. Until next time, you can find us on the Bloomberg Terminal, Bloomberg.com, Apple Podcasts, Spotify, or wherever else you'd like to listen. We'd love to hear from you. We're on Twitter. I'm at Joel Weber Show. He's at Eric Balchunas. This episode of Trillions was produced by Magnus Hendrickson. Bye.